Hello traders, hope you guys are good and welcome to my channel. If you're new to this channel, kindly hit the subscribe button and like this video. If you're a returning subscriber, welcome back and I hope you enjoyed today's video. Today we're going to be talking about market makers. Hope you stick around till the end and enjoy this small presentation that I prepared for you guys. Here's today's table of contents. And yeah, we're going to be discussing supply and demand and market makers and their role, and also giving an overview on their business model. In the next video, we're going to be going deeper into how they actually make money and issues of order flow mechanics and liquidity. So yeah, let's start by revising this concept of supply and demand. I've actually explained it, tried to explain it by illustrating on a diagram on a video. I think it was on support and resistance. So how to draw support and resistance. I will leave the link to that video in the description box. So stay tuned for that and watch it if you still haven't. So yeah, anyways, supply describes the amount of a product that a producer is willing to produce at a given point in time. Demand describes the amount of a product that producers or consumers, are willing and able to consume at a given point in time, right? Now, consumers are more willing to purchase a good if it's cheap, as demand will have a negative relationship with price, meaning as prices increase, demand will decrease. This makes sense. People are more willing to purchase a good if it's affordable. That's why you get more VWs and more Toyotas on the road than you get Rolls Royces and Ferraris, because the cheaper the good is, the more accessible it gets, right? Whereas it's the opposite with producers. Producers are more willing to produce if they are able to maximize their profit on a sale. Thus, the higher the prices of goods, the higher the supply. And I'll make an example with a notebook. If it costs you 500, if it costs you 5 rands to produce a single unit of a notebook, right? You are going to be more willing to produce that notebook if the market price was 90 rands over when it was 20 rands, because when it is 90 rand, your profits are going to be higher, right? And yeah, with demand and supply, we talk of an equilibrium, right? Equilibrium is the price that consumers and producers meet. So that say that point where consumers agree on the price of a good and the quantity that it has to be produced in, that point we call equilibrium. Then you have the opposite of equilibrium, which this is when supply exceeds demand or demand exceeds supply. When supply exceeds demand, prices drop, and when demand exceeds supply, prices increase. Hope that makes sense. If we use this understanding to describe the psychology behind prices in Forex, we would come to the conclusion that the market is essentially a tug of war between buyers and sellers, that there are only two parties in Forex, the person selling a currency and the person wanting to buy a currency. And the two, for every trade to be taken, whether it's a buy or sell, there has to be someone on the other side who's willing to match your offer. So like I said, e.g., if you wanted to sell 10 units of a currency, there always has to be someone on the other side who's willing to match your offer. But what if there are extra sellers in the market? They would have no one to sell to, because there are not enough buyers to clear out the supply. Prices wouldn't move because if sellers had no one to sell to, they would have to sit on their stock and wait. But we said demand exceeds supply. But if no one is willing to buy on the other side, how are prices going to move? So now this is where the market maker comes in. And the best way to explain the market maker is by using the model of a retail store. So you have a manufacturer, right? And then you have a customer. So now, most of the times you will find that a manufacturer does not have a strict relationship with the consumer, right? Because there are a lot of things that goes into taking a product from a manufacturer to a consumer. A product has to be processed, a product has to be checked, and a product has to be distributed. At the same time, you have to get your product to a point or a common meeting point where it is easily accessible to the consumer. So now a manufacturer does not want to worry about all of those, right? So they outsource or they hand over their duty to someone, right? And consumers don't want to go through the trouble of looking for manufacturers for different things. So they rely on someone to provide that good for them. This person is called a retail store. So the retail store or the retailer is a connect between the manufacturer and the consumer.
Another way of explaining why market makers exist is by using the example of a car dealership. So now, this is a car, by the way. So a car dealership is a marketplace, generally, where you get a person who's selling a car and a person who wants a car. It's a matter of convenience. Whenever you want to sell your car, you know that you can sell it to a car dealership and you don't have to worry about finding a potential buyer for your car. Similarly to where you want to buy a car, you don't have to worry about looking for someone who's selling their car or a manufacturer for a car. You know that the car that you want is probably at the car dealership. Car dealership buys the car from the potential seller and sells this very same car to the potential buyer for a commission. So market makers use the same model, right? You get people who want to sell stock, and then you get people who want to buy stock at the same time, right? But this process has to happen in a matter of seconds, right? So you don't want to go through the trouble of looking for sellers, especially because it's the internet now. Thanks to technology and thanks to the internet, we can, if you want to buy, you can find an instant order online. You can find an instant order online. Market makers exist so that there can always be liquidity in the market, right? So similarly to a car dealership, whenever you want to sell, you can sell. Whenever you want to buy, you can buy, for as long as there's liquidity.
The only two parties that exist is customer and market maker. Customer being tourists, hedge funds, retail traders, insurance companies, mutual funds, commercial businesses. Market makers being brokerage firms. And in brokerage firms, here is where we refer to B-book brokers, but we'll talk about it in another video. And then we have investment firms. A market maker act as counterparties to investors' trades in the financial markets. Going back to that diagram, this means when you wish to buy, the market maker will provide a bid quote. And if you wish to sell, the market maker will provide an ask quote, right? As a major provider of liquidity to the market, market makers will always take the other side of your trade, regardless of whether they believe the trade is likely to be in their interest or not. So as the market makers are counterparty to your trade, they profit when you lose and they lose when you profit, right? So like I said, their role is to provide the market with liquidity. Market makers ensure that there's always gonna be a counterparty to a trade. They provide their own quotes, which allows them to buy at the best bid available and sell at the best price on offer. This difference between the bid and ask is also known as the spread, and provide the broker or the market maker with their source of profit. So like I said, with the retail store, their profit is called a markup. With the broker or with the market maker, their profits are called the spread. The spread is the difference between the bid and ask. The higher the ask price is compared to the bid, the more profit the market gets, right? And the spreads compensate the market maker for the risk they took with the trade. So now with highly competitive markets, there are going to be a lot of market makers. And now because there's a lot of market makers, these people have to be highly competitive in their pricing. That's why you find that with a lot of major pairs, the spreads are lower than on minor pairs or on exotic pairs, because if you have a lot of market makers competing in one market, this is where you find that the spreads are getting smaller and smaller compared to other markets. I hope that makes sense. The more liquid the market, the lower the spreads are going to be, because market maker still has to compete against other market makers, right? They take on a natural risk by being on the counterparty when trading with informed traders. The more informed you are, or the more profitable you are with a broker, the more you pose as a risk for them. So this is why we get market manipulations. This is why sometimes conventional trading methods trade against the retail trader or the less informed trader, right? Because if the majority of us are good, then they don't get to make their money. Remember, whenever we make money, they lose money. So market makers can also lose money if the market moves against them and they are unable to respond. If the market moves against them, they are unable to respond to these events fast enough. So now, to protect themselves against these losses, they adopt hedging strategies, they trade small, and they don't use leverage. So yeah, I hope that explains what the market maker is. Like I said, there are going to be other videos soon. And yeah, thank you guys for tuning in. Till we meet again. Peace.